The most dangerous thing you can believe as a beginner investor is that you need to be certain before you invest. You don't. In fact, you never will be. You can research a company for hours. You can study its earnings, read the news, watch analysts, and convince yourself that you finally found the perfect investment. Then you buy it. The next morning, it drops 8%. And suddenly, your brain starts screaming, "Sell!" That moment is where real investment psychology begins. Because the question isn't whether you can predict the market. You can't. The question is whether you can remain rational when the market refuses to behave the way you expected. Imagine two beginners buying the same stock. The first buys because everyone online is talking about it. The second researches the business, understands the risks, decides how much to invest, and knows what would make them reconsider the investment. The stock falls 10%. The first investor panics. The second investor checks the original reason for buying. That is the difference between confidence and certainty. Confidence says, I might be wrong, but I know why I made this decision. Certainty says, I know this is going to work. And certainty is dangerous. So before your next investment, ask yourself 5 questions. Why am I buying this? What could go wrong? How much am I willing to lose? What information would change my mind? And most importantly, am I acting because of research or because of emotion? These questions create something far more valuable than confidence. They create control. Because fear wants immediate action. Greed wants immediate action. FOMO wants immediate action. Your investment process gives you permission to stop. And that pause can save you from some of the worst beginner investing mistakes. But there's another secret. You don't build confidence when your investments go up. You build it when you make a good decision and the outcome still goes against you. That's when you learn whether your process is actually strong. A stock can fall after you buy it, and you can still have made a good decision. A stock can rise after you buy it, and you can still have made a terrible decision. The outcome does not always tell you whether the decision was intelligent. That's why the goal isn't to become an investor who is always right. The goal is to become an investor who can think clearly when being wrong is possible. So stop asking, will this stock go up? Start asking, do I understand what I'm buying, what I'm risking, and why I'm willing to own it? That shift from prediction to preparation is where investment confidence begins. You don't become confident because every investment works. You become confident because you learn how to make rational decisions when you cannot control the outcome.